Okay, welcome back to another episode. Today we are interviewing Piotr Muha with some finance questions for you lot.
Thank
Okay,
you.
Piotr, you with us?
Yes, let's start.
Okay, the first question, why should young people learn about money?
So I think it's very important for young people to learn about money because the system and school is designed in a way that you are there to get education and finally get a job. However, the purpose of a job mainly is to earn money. Therefore, why aren't we teaching kids about money in the school system? I personally think it's a little bit elitist not to do that, to keep all of the financial knowledge only for the rich people. And I think that's why young people need to study money by themselves in order to get educated and to make that money work for them.
Yeah, I agree with that, to be honest. Yeah. Okay, so number two then, for the second question, what are the best sources to learn that knowledge then of how to make money?
So, finance, investing, and business is a numbers game. Therefore, we don't have to guess who is the best investor or who is the best business people. If you look at the richest people in the world, we can say, oh, therefore Elon Musk has something that is really great to emulate. Or investors like Warren Buffett, who is one of the richest people, in spite of donating half of his wealth already to charities. Therefore, we can just see, oh, this person over the period of 50 years was able to outperform the market while investing, then he has something that truly works. Because a lot of young people nowadays, I think that they follow speculation, day trading, and things like that. And based on statistics, 96% of them lose in the period of 5 years, so majority of them. And this is because of many different reasons, but they are competing with big corporations that have very advanced algorithms, like basically AI that trades against them. They have super lightning fast connection to the stock market and to the news, so they can outperform them in terms of speed but also analytical power. So I personally would recommend people like Warren Buffett if you want to start investing, because he has this great performance over the last 50-60 years, but also he shares his knowledge. You can find it freely online, or there are many books written about him.
Okay, so then about this Warren Buffett guy. Once he famously said that the best investment you can make is in yourself. Now, for a young person or a volunteer who might not have much money yet, what does investing in yourself actually look like?
This is one of the best investments to start with. If you don't have a lot of money, you can still educate yourself or invest in things like health and well-being. Think about it. What would you focus on if you already had the money? So for instance, a lot of billionaires might have a lot of money, but truly they might not be happy, or they sacrifice their health in order to achieve this money. So those things I would focus on. And of course, education. If you want to start a business or invest on financial markets, you need to remember that it's a competitive sport. If you are better than the rest of people in terms of your knowledge and understanding of the market, you will probably earn money. However, if you are significantly worse, uneducated, and you try to compete on the stock market, for instance, with professionals, the probability of you actually making money is very slim. And also, it's one of those investments that nobody can take from you. It cannot be inflated. So it's safe. Whatever you learn, it stays with you for the rest of your life, hopefully. And it's also very important to keep on learning. Many people after they leave school, they say, oh, no more learning, I'm so happy. But really, if you are not growing in life, you are, in my opinion at least, getting slower and slower. And if you don't practice your brain in the old age, it will be very detrimental to your health.
Yeah, so I agree with you completely. And now for our whole audience who is full and know and care about the social media impact, is it possible to be a Buffett style sort of investor who only supports companies that do good in the world?
So yes, you can do that. However, it is a little bit tricky. So many companies nowadays, there's this trend towards ESG, so social governance and ecological friendly companies. However, many companies say that they are eco-friendly and they care for their workers, while in reality it's a little bit different. So it's sometimes hard to distinguish good companies from bad companies. For instance, I owned some companies from China that when ESG became more popular, they just added it to their name, but the reality of the company didn't change much. And as you know, Chinese companies, because they are the producers, they really have the factories, etc. For instance, they emit a lot of carbons and other harmful gases into the atmosphere and consume a lot of power, etc. But yeah, of course, if for instance you don't want to invest in tobacco companies, you can stay away from them. There are like 1,000 different stocks that you can invest in. But also one important thing to say is that when you would invest a small amount of money into a tobacco company, so a non-controlling share, then you are not really giving your money to the tobacco company. This is not like an IPO special type of situation. You are just trading shares with a different investor. So it doesn't really help the bad company. So I would say there isn't a lot of harm if you invest even in a bad company, because you're not really helping them.
Okay, so fair enough then. So fair enough. Okay, so now back for our audience again. For a young person with only $50 to $100 a month, is the Buffett style even possible?
I say it is. Nowadays, there are many brokers that can give you an option to trade or buy, invest in something called fractional shares. So for instance, you know that some companies, like for instance Microsoft, one share of Microsoft is around $400 US dollars. So if you have only $50 normally, you wouldn't be able to buy into that company. Furthermore, if you invest $50, you would pay also commission, a special fee to the bank, so that it manages that purchase. So if you are investing only $50 and you are paying, I don't know, $5 in fees just to open the position and then another 5 to close it, you would lose around 20% just on fees. So that won't work. However, nowadays, many brokers offer fractional shares or investing without big commission or no commission at all. There are also brokers like that. So yeah, in this case, you can buy a fraction of share of, let's say, Microsoft, maybe 0.2 shares, and sometimes pay zero commission. So yeah, you are able to invest even very small amounts.
Oh, okay then. So, okay, let's say you saved $1,000 from a part-time job. What would be the very first thing you would move towards in the value investing philosophy?
So if I had my first $1,000 to invest or do whatever with them, I think the first thing is to purchase something that will make you feel a little bit more secure. Let's say a bond or a saving account. So if anything happens to you in your life, you can take this money. It's like your safety net kind of thing. And also $1,000 is not a lot to invest in stocks, etc. However, it is a lot to invest into education. Of course, nowadays we have also free resources online. However, it's a little bit more difficult to find something that is of great value online compared, for instance, to a book. However, I know that reading a book nowadays isn't very popular. It takes a lot of focus to read it, and with our society so focus on like short-term gratification, a lot of dopamine from short-term content, etc., it can be difficult to focus and read the book for a prolonged period of time. However, I think that's the best way to invest the first $1,000 is just to educate yourself and grow as a person.
Okay. And so, what is the circle of competence, and how can a young person figure out theirs?
So a circle of competence is a very important thing also for investing, but also for anything else in your life. It is a thing that you are an expert in. So if you want to invest on the stock market, or if you want to grow your business, or if you just want to be a good employee, therefore you should focus on a skill, service, or a product that you're an expert in. You can, by doing that, easily outperform the competition and make money on the stock market, or make your business bigger and better than the competition, and also be a good, reliable employee that will not get fired because you make a mistake. If you're an expert, then they will want to keep you there. And circle of competence can also be grown. So as you are learning and expanding, the circle of competence can expand with you.
Okay. And now, how can we use the value of investing mindset to choose a career or a way in life?
So value investing focuses on things that have real value, real utility, and also that are in your circle of competence. So I think in order to choose a career in life, you need to have something that can for sure make you money, because you need to have some cash to afford food and roof over your head. But it should be also something that interests you. A lot of people don't like their job. Of course, some jobs are very demanding, etc. But I think if you follow your passion, even though at first it can be much more riskier, for instance, if you want to start a business or if you want to invest, but also if you want to be, I don't know, a comedian or a painter or a musician, sometimes those jobs feel a little bit more risky. However, if this is something that you really want to do, I think over time you will outperform the competition, and just through the amount of time you are willing to put into it, because for you it's just play, you really enjoy it, you will be able to make a living and stay happy and consistent with your personality. So I sometimes feel people, become an accountant, it's a steady income, etc. However, I know many accountants who lost their job even after being employed for like 10-20 years in the same company. So of course it can be safe, but it is not always.
Okay. And now, so why does Buffett prefer boring companies over exciting, and how can it translate to life decisions?
So when something is exciting and very popular, for instance on the stock market, a lot of people will go into that and will buy the stock, driving the price higher, meaning there will be no special opportunity there. If a lot of people are interested in something, they will drive the price higher and higher and higher, usually to an overvalued state. If you are going into a business that is exciting and very popular, there will be a lot of competition. You won't be able to make a lot of money if you have to lower the prices or spend a big amount of money on marketing just to fight for a share of the market. If you want to be an employee or do whatever in your life, you need to look for things that aren't hyper popular and where not a lot of people are going into. So if you want to, sell shoes, there are many different shoes manufacturers. People don't need a new brand of shoes, for instance. However, there are some businesses, maybe they're very difficult to get into sometimes, that have higher demand than what is being produced. And there you can really help people because, for instance, prices of certain things are expensive because of high demand. And in that environment, you don't need to spend a lot on marketing. You don't need to worry about will there be clients. If people need it and you are really supplying something that the society needs, you are doing a good thing, and also the market will make sure that you make good money on that.
So can you explain compounding in a way that doesn't involve a calculator?
So compounding is very important, not only in investing business, but also in life. It is a thing that creates a multiplicative growth. So let's compare it to a normal job. In a job, you earn, let's say, $10 per hour. And if you work for 10 years, of course, you may get a raise, but still 1 hour of your work means $10 or later a little bit more. However, with investing, for instance, you are not making $10 per hour, but you are, let's say, making 10% a year. So if you invest $100, the first year you earn $10. But for the second year, you will have in total $110. So you will earn 10% of that, which is $11. So you see your income increased. And at first, that increase is very slow. But because it's multiplicative, after some years, it will start to be very, very rapid. It's very difficult to comprehend it because not a lot of things in life are like this. A lot of things are more linear, so like earning that $10 every hour. But if you can find things that have this multiplicative growth in your life, it can be really, really beneficial because there is basically no ceiling to that.
So is it better to buy one great company at a fair price or 10 okay companies at a cheap price?
So I think it is always better to pick smaller amount but better quality than to pick huge amounts of different things and investments of worse quality just because they are cheap in price. Their worse quality might be the reason why they are cheap. And over the long term, the cheap, badly managed companies will underperform the few great companies. And it's normal that when we want to invest in something that is really good, we don't have 1,000 different options. Maybe we have few options that we can pick from at the current time. And let's compare two different scenarios. In one scenario, you are buying 100 different bad companies. Why would you do that? Why wouldn't you just pick 10 best companies out of those 100 and invest into those? Some people say, oh, that's diversification, etc. But it's really diversification, meaning just because you have a lot of things doesn't mean you are reducing your risk. You are actually increasing it. If you are investing in something that is bad, that's risky.
Now, how do we distinguish different price and value in everyday life?
So we need to understand that the price of goods and services are determined by many different factors, not just value. A very simple example, I always thought that the red onion was much better than the standard white onion because in my country it was more expensive. But then I went to Greece and there it was completely flipped. The standard yellow onion was more expensive and the purple onion was much cheaper. So I figured out, okay, it's not the value of the onion that matters, but maybe where it grows, etc. So always try to think about it. Are you buying something that is made local? Then it will be cheaper, not because it's worse, but because there's less distance that the good needs to be transported. And it's also good for the planet. You don't need to be buying things that travel the whole globe. You can buy local and it will benefit the society and also the environment.
Now, what are the physiological traps that make young people want to do day trading or gamble on crypto?
So gambling on cryptocurrencies is very popular because it offers an easy way to multiply your money in a very short period of time. So if a person has small amount of capital, for instance, $1,000, if they earn 10% per year, it's not very appealing to them to make $100 in 1 year. It's a very long period of time. But while gambling or day trading on cryptocurrencies or other maybe leveraged assets, they can make 1000% gain in 1 day. So it's very appealing. This is a psychological phenomenon that people tend to be really hyped about things that have small probability but huge gain. So even though most people lose money on day trading or gambling on crypto, even if they think that there is a 1 or 2% chance to make money big, they will still go for it because that big reward really skews their logic and makes them make that very risky gamble.
Now, can crypto have real value or is it just gambling?
So cryptocurrencies can have real value. However, it is very difficult to find crypto that really does have any underlying utility. So at some point, cryptocurrencies were super easy to launch. And I think there were like thousands and thousands of new cryptocurrencies created every day. And most of them did nothing. There was no utility underneath it. So if 99% of all the currencies have no utility, then it's very difficult for a person who isn't educated, doesn't spend enough time to do a research to pick a good one. If you just pick a random cryptocurrency to buy in, the probability that you are buying something that has real value and real utility is very slim. So yes, there are some cryptocurrencies that have great utility, but you need to do research in order to find them.
Okay. Can investing align with ethical or sustainable ESG goals?
So yeah, investing can align with those. You can pick companies that are eco-friendly. For instance, there are companies that grow trees. There are companies that clean the air. So if you want to strictly invest in those, you can. However, you need to be careful because it is a popular term, ESG, nowadays, and some companies say that they are ESG while in reality they are not.
Okay, now what is the most common mistake young people when they first open up an investment account?
So I think most young people tend to look for a quick gain. They usually go for financial instruments that are leveraged, like CFDs. And those instruments, it's basically a loan. Your broker or bank gives you a loan. Usually you need to put up only 10% or even smaller portion of the capital. So if you have, let's say, $1,000, your broker in Europe can give you up to 30,000 of a loan. And most young people will go into that. They will borrow that by buying CFD. They will get this huge investment loan. And yeah, statistics show that over the period of 5 years, 96% of people who trade or speculate using those CFDs, so those leveraged products, lose money. And they do that because it offers them that huge possible reward, right? You can triple, double, quadruple your money in terms of hours sometimes, and that really makes them very emotional and very greedy and blocks the logical part. And yeah, in the end, most of them lose.
Okay, so is patience the most valuable currency in the stock market?
Patience is very valuable because if you invest in a company, in a period of 1 day, the company will produce only a little bit of profit. But if you have a great business and you wait, let's say 10 years, over that period, that company will grow in its size, will generate tons of profits, maybe buy you a lot of dividends. So yeah, on the stock market, you make money by waiting and holding onto the company for a prolonged period of time. If you want to like speculate, that's more of a gambling, to be honest. So yeah, time is very, very important. That's why it's also very nice to start young, because you have a lot of time for your money to compound and grow into those unimaginable amounts.
Okay, now how do you actually calculate the intrinsic real value of a company?
So value of a company can be calculated by looking at its cash flows. If one company is making $1 and another company is making $2, and let's say they will continue that into the future for the next 10 years, of course the second company is worth twice as much. Of course there are many different factors to consider. For instance, the economic mode, so like competitive advantage, how useful is their product. So for instance, in the past, newspapers were some very safe business, but with the growth of internet, of course, they lost their competitive advantage. So we need to look also for that shift. So some companies, in my opinion, for instance, accounting firms, they need to invest in artificial intelligence, or they will get eaten by their competitors. But yeah, intrinsic value, real value of the business is really, we look at the cash flow of the business and you discount it to the present value, which basically means if the company will make the money very late into the future, maybe it will make the money in a few years, that amount of money is worth a little bit less than if this company would make this money today.
Could you tell me what the difference between investing and speculating is?
So investing, you can buy a company because you think it's a great business. You see that it will produce a lot of cash flows for you, and you believe in it. You think it has a great product or service, and you tend to hold it long term because the value of the business, in your opinion, is very good. And speculating would be buying a business not because you think it's good, but because you think the price will go up. So it's basically a little bit like gambling. You think that this stock will skyrocket in next few days, so you buy-in, usually using leverage, and in the end mostly lose money.
Now, how do you know when it's finally time to sell a stock?
So I truly believe in the fundamental rule of investing, which is buy low, sell high. So I tend to buy companies that are of good quality, but I also don't want to overpay for them. Even if you buy a good company, but you pay 10 times more than it's worth, you'll still lose money. Therefore, I look for stock market crashes or periods of negative investor sentiment, of bad psychology, so people are scared, they are selling the stock, and I'm looking for short-term problems or fear on the market, so something that will pass, but people are short-term focus. A lot of money on the stock market is short-term focus, so I tend to buy from a fearful pessimist investor, and I hold my stock until it approaches a high valuation. So if the market becomes super optimistic, for instance, I own Google, it's a great company in my opinion, I think it will continue to grow. However, if Google at some point, if investors become too optimistic and the price of Google skyrocketed and the valuation became just crazy, and if at the same time I had a better opportunity, then I would sell my Google stock and buy that better opportunity. However, what is also important to consider are taxes, but on the stock market there are some instruments that let you legally avoid paying taxes. So for instance, if you have retirement stock market account, you can sell that stock and not pay taxes on that legally.
Okay, so who is Mr. Market, and why should we treat him like a servant rather than a guide?
So Mr. Market is a term created by a famous investor, Benjamin Graham, and he said that stock market often behaves irrationally because of human emotion and psychology. And this Mr. Market guy, basically every day you have a different stock price that you can buy or sell your stock at. And sometimes Mr. Market becomes very pessimistic and depressive, and he'll say, oh, the economy is going down, it's end of the world for this company, etc. And he will be willing to sell you a stock of a company for a very, very cheap price, and you can take opportunity in that. And on different days he might become very optimistic. He say, oh, the stock market has been rising very rapidly in the last few days, months, or years. Therefore, it will continue to do so forever. There is a lot of money to be made, and he will be buying everything because he's very optimistic. And then you can sell to him for a very high price your shares.
Okay, now the index fund, for example, like the S&P 500, is that really the best choice for about 99% of people?
So usually I would say yes, it's a great option for people who don't know a lot about investing. So an index fund like S&P 500, it holds like all the biggest 500 companies from USA. And usually they are the biggest 500 companies because they are very good, right? They manage to grow, beat their competition, etc. And there are index funds from many different countries, many different sectors and regions, so you can pick even stock market index from your country, from your stock exchange. However, you also need to check if that index fund is cheap or expensive. So what you can do is you can just Google the index fund name and then price to earnings ratio or price to book value ratio. And that will show you how that price to earnings ratio of all of those companies in the index fluctuate over time. So if currently that price to earnings ratio is very high compared to the past, you don't want to be buying that, of course, because it's expensive. You want to be buying something that is at a fair value or maybe even lower than the real value. So during times of panics, during times of market crashes, and not when something is very popular and everybody is buying, because then it will for sure be expensive.
Okay, now that's it of the questions that I have.
Okay,
for you.
thank you very much. And yeah, it was great recording with you. And yeah, hopefully listeners will also get a lot of value from that. Thank you very much.
Thanks.